Hello, everyone. I'm Terence Vanderwood, co-host of Dollars with Sense radio show and podcast here with my fellow financial guru, Ela Lange.
Hi, everyone. Hello, Terence. Thank you very much. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. Contributing to your Registered Retired Savings Plan, RRSP, is one of the most beneficial and efficient ways to both save for retirement and reducing your annual taxes.
Yes, the Registered Retirement Savings Plan, or RSP, as you said, is a excellent way of how to put money away for your retirement and also to save on your taxes now.
Let's address a few important points. How putting away money into my RRSPs reduce my taxes? Well, RRSPs offer immediate tax relief by lowering your taxable income for the year, say 2016. We've just finished. I made, let's say,
$60,000?
Okay, $60,000. So let's go from there. Terence.
Sure. So you've got $60,000, and let's say we got to take a look at what tax bracket that's in. So for the 2016 taxes, if you made $60,000, the government says that you owe them 28.2% of that $60,000. But it does offer a few ways in how to reduce that. One is through RSP. So if you're making $60,000 and for every $1,000 that you put into your RSP, you will receive $282 back for every $1,000 that you receive. That's what your refund will be. And on top of that, what CRA does is it calculates your income as $59,000 instead of $60,000. One of the key elements that we do here as financial planners is we try and equate the amount of money that you give towards your RSPs to put you into a different tax bracket. For instance, the 28.2% tax bracket ranges in 2016 between $45,000 and $76,500. So if you can contribute $16,000 to your RSP with a $60,000 income, then you will drop a tax bracket because you will have tax on the income of $44,000, which puts you into the 22.7% tax bracket. So all of a sudden, with doing that, you are paying 6% less on your tax bill.
And here's a little point of interest. 2016 CRA, the Canadian Revenue Agency, put a contribution limit of $25,370. So I'm putting that on the screen as well. The chart you saw earlier was to give you all an indication of what the 2016 taxable income rates were. So you can always look at where your income fell within those parameters and have an idea of what percentage CRA would tax you on.
Yes. So that's sort of one of the aspects of that's very beneficial towards contributing to your RSPs, how you can reduce your taxes today. And then, of course, your RSPs are meant for long-term savings so that it can go towards your retirement. You will have to pay taxes on those, though. RSPs are considered tax deferred. In other words, you're not paying taxes on those dollars now, but when you do redeem them or when you do take them out after you and use them for your retirement, then you will be taxed on them. The advantage to that is ideally when you're retired, you have much less of an income, so you drop yourself into a lower tax bracket, and therefore you're paying less taxes on those dollars. And you have done a savings of tax by deferring those taxes until retirement.
Again, the CRA allows you to defer those taxes right up into the year you turn 71. When it's actually, you have to convert your RRSP to a RIF, which becomes an income. Again, you can take the minimum as from the age, you must take in it by the age of 71.
Yes. So you're saying then that, like, I can't pull out the RSP funds for my dream vacation to Japan. How about that?
Well, that's something I would think in 20 years from now, I could start taking money out. But until I've converted into a RIF, yes, then I will be taxed at the tax rate if I'm earning $60,000 or $100,000, that's putting me into a higher bracket. But once I've converted and, I'm retired and earning a far less amount of money annually, well, why not take money then and go to Japan and have your dream vacation? You can afford your dollar will go a lot farther, that's for sure.
Yes, definitely go a lot farther. Yeah, so RRSPs are designed for long-term investing. The very nature of this type of investment vehicle is such that there is a great incentive to avoid dipping into your savings. We go into much more detail around that in another episode called Resist the Dip. That will be coming in the future. It's available right now on our podcast, which is you can easily find by going to the YouTube search bar and typing in Ela and Terence. And you will see all of our 39 right now. We're in the midst of recording our 40th episode to go as part of the podcast where we cover all levels and all areas of financial planning and how to use your finances wisely to grow and protect your wealth. So don't dip into your savings. This encourages you to stay invested over the long run and reap the benefits of all the market activities as well.
So Terence, just to remind everybody that if I can't maximize or sort of use the maximum contribution room that I'm allocated every year to my RRSP to reduce my annual tax, well, it's still beneficial to put something aside if I'm earning, let's say, when I look at my chart, over $45,000, even $40,000, because, again, it helps me move my tax bracket. But I decide I'm going to put something aside anyway. How does that help me in the long run?
Well, Ella, that's very, very beneficial. So consider this for a moment. Say we've got one individual. They're basically two friends. We're going to call them Susie and Ann. Susie and Ann are friends, and they are in their 20s. Let's say they're just turned 20 years old, and they both decided that they want to invest $2,000 a year into their RSPs. So Susie does this. Ann, on the other hand, decides that she doesn't have enough money and she'd rather spend it right now. Susie dutifully puts it away. $2,000 a year, and for a total of $18,000 over a 9-year period, at which time she becomes disabled and can't afford to invest into her RSPs anymore. So she's only got 9 years of $2,000 a year. That's $18,000. Of course, when she becomes disabled, it becomes a very trying moment for Anne, and Anne sort of calls it her wake-up call and says, I got to start saving because this could happen to me. So the wake-up call, and decided it was time to start her own $2,000 a year investment into her RSPs as opposed to just spending it. But she started 9 years later. 9 years later. So let's fast forward, way forward. And at the age of 65, they're both, Susie and Ann, are both ready to retire. There's still a difference of their investments, even after one of them has invested $70,000. Ann has invested $70,000 over 35 years. So Susie invested $2,000 per year from age 20 to 29, so for 9 years, with a total investment of $18,000. The possible value based on we're just looking at the details here. So this is the assumption that the $18,000 that was invested by both Susie and Ann earn an average rate of return of around 8%. They're both moderate aggressive investors, and so an 8% over that period of time gives Susie a value at age 65 of $398,000, or almost $399,000 actually. Again, she invested $18,000 for $2,000 a year for 9 years, stopped when she was 30, let it grow for 35 years, and now she's got an almost $400,000 nest egg. Anne, on the other hand, invested $2,000 a year from age 29 to 63 for 35 years. She invested a total of $70,000, and her possible value, again, a moderate aggressive investor with about 8% annual rate of return, she realizes around $372,000. So this is the power of compounding, and procrastination can be very costly. Again, Susie only put in $18,000 and is almost at $470,000, where Anne put in $70,000, 70, and has a value of that's about $28,000 less than what Susie's is. So there you have it, the power of compounding. So it does make sense to put whatever you can towards your RSPs and keep it in for the long term.
And what also makes sense, if you think about how a disability can alter a financial plan quite considerably, as you've seen with the numbers, is consider disability insurance. If you have to stop working and you're counting on making contributions on a regular basis or even paying your bills, you don't want that kind of interruption in your investing, and you see exactly why, that power of compounding.
So any of the income you earn inside your RSP is not taxable, as I said before, until you withdraw it from your account. This means your investments can grow on a tax-deferred, like I said before, basis right up until the end of the year you turn 71 and fully benefit from the compound growth. See how it works, the rules behind an RRSP, again, a registered retirement savings plan, is that is the savings vehicle until you are mandated by the government at age 71 to change it over or convert it to a registered retirement income fund, or a RIF, R-R-I-F. Once it becomes a RIF, the government has set out mandated percentages that you have to withdraw that money from. So, for instance, for somebody who's 71, I believe it's around 3.8% of the total value of their portfolio that they have to pull out. So if somebody has, let's say somebody has $500,000, no, let's say somebody has, keep the math easy. So let's say somebody has $1 million in their RRSP, then every year, the year after they convert it, they have to draw out $38,000. And then the next year they have to withdraw. And that $38,000 then gets added to your taxable income for that year, and you pay taxes on it. So that's how it operates. That's how the government can defer the taxes, but they do get them.
So it means that if you take the right steps to take advantage of all the little things within your control, you can ensure that you have a sound financial strategy that will carry you right into retirement, allowing you to enjoy the ride along the way. In other words, you should care very much because it gives you peace of mind.
That is a very important part of it. Thank you for that, Ella. Now, let's do some few housekeeping items for RRSPs so that everyone should be aware of. There are 4 main things to keep in mind when it comes to RRSPs. First, your contribution deadline. You have 60 days after the calendar year ends to make an RRSP contribution and deduct that contribution from the previous year's tax return. It usually results in a deadline on or around March 1st. It's interesting that they started the RRSPs. When did they start the RRSPs again?
I believe that was 1957. Yeah, that was in 1957, in fact, because you couldn't carry. There was no carry forward that you're allowed now. So there was that 60 days, if I'm not mistaken, that that was this rush that the CRA would give you, those first 60 days in the year to allow you to contribute, to make sure you contribute.
Yes, and I believe that if you did not contribute, then you would lose it. It's changed now. Since 1991, they've changed it over so that each year accumulates to the maximum of, as we said before, $25,000 for the year, or 18% of your income. So, for instance, if your $60,000 is what you're bringing in, and 18% of that is calculator. Ella is the calculator of our team here. So a $60,000 income equals $10,800 maximum you can contribute that year. Let's say it's this year of 2016. Your 2016 taxation year, you can, if you made $60,000, you can contribute up to $10,800 for that, plus the additional room that you have from previous years, which again has only started since 1991. That's why the rush for the 60 days was actually created back then, so that people who didn't contribute throughout the year from 1957 to 1991, they had to contribute in the first 60 days of that year or they would lose it.
So now just be careful though. Rules to determine contribution limits are integrated within limits for pension plans. So if you're one of those lucky ones who are a member of a company-sponsored registered pension plan or a deferred profit sharing plan, also known as a DPSP, you will have a pension adjustment, or PA, which is reported on your T4 each year.
There is a good thing to note as well. The government does give you a grace of up to $2,000 in your lifetime to over-contribute to an RRSP. So if you over-contribute to your RRSP less than $2,000, the government goes, you shouldn't have done that, but that's okay, we're going to let it go. If it goes beyond that $2,000, and I've only had this happen to me once, and I don't need it to happen to me again, you basically are charged 1% monthly. Amount that you over-contributed, that becomes a penalty from the federal government. And then, of course, you're charged the interest that the government charges on monies owed. And it also has to be paid back, and the government will consider it part of your income for that year. It is a very long and drawn-out paperwork process, so I would highly recommend that nobody over-contribute to their RRSP contribution. They make it very, very difficult. And I guess that's to be very strict about not over-contributing to your RRSP.
In case you don't know how much contribution room you have, the best way to determine that RRSP contribution limit is to look at your most recent notice of assessment that's probably sent to you in the post from the Canada Revenue Agency. And that is after you file your tax return each year. You should receive it in the post, and that will state on page 2 quite concisely what contributions left over, what's carried over, what's taxable, and so on and so forth. So including pension adjustments. All of that's on your notice of assessments.
So that is the reason why it is good to care, because caring saves you money. Caring about your RRSPs helps you save money, but rely on your professionals. An accountant is somebody who can help you out with how much your RRSP contributions can be. Accountants generally take care of past taxes, where a financial planner actually takes care of your future taxes. So between your accountant, your financial planner, who also is your wealth manager, and other professionals, you can consider yourself in good hands as long as you rely on them. And if you don't have one, if you don't have a financial planner, and you may think to yourself, are there any advantages to having a financial planner? Well, look up on your screen and you'll find what's called the value of advice. And it's a statistical snapshot of Canadians from an Ipsen Reid poll on where their assets are in relation to their age and to their income level. And as you can see, the ones with less are the ones who I call the do-it-yourselfers, those who do not use the professional advice, where the ones that have the larger amounts of assets, up to 4 times on average, and in its most common case, almost 7 times, and those people are the ones who use a financial planner. So the value of advice is can be up to 7 times worth your assets, which is a huge amount of money.
So your action item for this week is to look up your notice of assessment, and you can access your information online through the CRA website. As soon as you've filed, you should have received your NOA with your return. So check it out and look at your cash flow, look at your annual income, and ask yourself, Is it worth making a contribution?
Another option, if you don't have the budget right now, and it's quite a smart way to do it as well, is to have an RSP loan. So you borrow X amount of money, and then you pay that back. Now your return's going to be less because it's going to cost you some interest to borrow, but if you're looking at a 7% reasonable rate of return over the long term, and it's costing you 3% to borrow the money, then you're still making 4%, which is not as ideal as 7%, but it does help you get along your way to your retirement goals. RSP loans have been around for a very long time, and many people have used them to help accelerate their RSP savings. So again, your call to action item is to look up your notice of assessment, your 2015 notice of assessment, and it will tell you how much contribution room you have for 2016. And once you've found that, make sure that you make a decision well in advance because the deadline is the end of February.
Just so you know. That's it for this week. Yeah. Thank you very much for joining us today. And thank you, everyone, at 98.7 The Point for airing this show week after week and for giving us the time to be your financial gurus by offering you, the listeners, our valuable financial insight. Check out our Facebook page, Dollars with Sense. You can listen to our podcasts and of our shows that are available off our YouTube channel. You just need to go to the YouTube and punch in Ela and Terence on the search bar, and you'll see our 39, now 40 episodes available to listen at your leisure. Call us for an appointment or for a personal financial review at no cost or any obligations at 778-879-0820. And certainly reach out to us by email. That's 2financialgurus, the number 2financialgurus at gmail.com. And we look forward to answering any questions or any comments, addressing any comments you may have.
Thank you again for tuning in today and joining us on this episode of Dollars with Sense. We hope you have found it to be useful, and we look forward, as Ella said, to hearing your comments and answering your questions. And we also look forward to seeing you back here next week for another knowledge-packed episode. Until then, Ella and I hope you have a really productive week, and
may your dollars and cents be with you.